Hey, this is Chris, and in this video I'm going to be sharing my tips for investing into cryptocurrency ETFs. Now last year I did a video which was more focused on how to invest in Bitcoin, and it wasn't which exchanges to use or how to buy it, but actually thinking about risk management when it comes to speculative assets generally. And I had a few tips that I shared, which I will share below a link to that video, which is a good one to watch before you watch this one if you haven't already. But my tips were, one, considering your financial position, whether you should be speculating at all, limiting your exposure to only a small part of your portfolio, dollar cost averaging, so spreading out your investments over a period of time, so you're not just buying when everyone's excited and the market might be at a short-term peak. Know your counterparty risks, so know who you've invested off and whether there's any risks if they blow up, and that's a pretty important one. I read in the paper recently that one of the cryptocurrency exchanges in Australia has blown up and lost a lot of people's money, so that's a really clear reason why you need to be aware of who your counterparty is. Remember to rebalance, so when things do really well, sell a little bit. Again, 2021 was a good example of why you need to do that, because after cryptocurrency had a big run up, it then had a 50% fall, and so making sure you're taking a little bit off the top when they do well is important. And then finally, ignoring short-term market movements, because it's easy to follow the day-to-day ups and downs. This is a very volatile asset class, and it's quite typical for it to be moving up and down quite a lot. The annual volatility of Bitcoin at the moment, for instance, is 82%, which means on a typical day you should expect it to go up or down by about 5% a day. So it's very normal to see it having falls of 5%, and actually having big pullbacks of 30 to 50% is also perfectly normal. So, making sure you've got a small position and not being stressed about these movements if you are going to invest in one of these speculative assets is important. In this video, I'm actually going to be more focused on cryptocurrency ETFs, which is a completely new phenomenon that's been happening over the last year. We used to only see the ability to invest into into cryptocurrency, directly via exchanges, either hold it at the exchange or take it onto cold storage. But now there's a new opportunity to invest into cryptocurrencies that has been authorized by some markets in the world and is going through the process of authorization in others, which is via an ETF format, which makes these cryptocurrencies very interesting because it makes them a lot more accessible to the masses to invest in, but it doesn't mean they're less risky. So I'm going to be talking about some of the differences between these ETFs and some of the risks. And I would summarize by saying that there are probably three types of cryptocurrency ETFs that we've really seen come out or be close to coming out. The first one is cryptocurrency ETFs that don't actually invest into cryptocurrencies themselves, but invest into companies that are involved. And so it's almost a derivative of cryptocurrency because you're investing into businesses involved in this industry. There's a few of these that have listed on the ASX, and I know there's others that have listed on other markets. These are interesting because they give you exposure to the overall sector. The challenge with them is they don't give you a very pure exposure to the actual cryptocurrencies. And so you may over time start to see a divergence in returns. You may see cryptocurrencies go one way, but these actual companies go a different way. And the reason for that is cryptocurrency as an industry is still very nascent. It's very early in its overall adoption, and the number of listed companies out there that are the big drivers of this industry is quite limited. I would liken it to 1999. There were a few tech companies out there that were going to be the giants of the future, like the Amazons and the Apples and Microsofts, but there are a lot like Facebook that hadn't been invented yet. So the problem with these ETFs is they may give you exposure to some of the players that may or may not be successful in the future. And if you're actually trying to get exposure to the underlying cryptocurrencies, they're probably not a very good bet, although they may generally move in the same direction. The second group are actual cryptocurrency ETFs that actually track the underlying assets, whether it's Bitcoin, Ethereum, or one of the other cryptocurrencies out there, but that don't track the underlying assets, but actually futures on the underlying assets. So rather than being backed by the assets themselves, they follow basically a financial asset that itself is derivative of Bitcoin and Ethereum, These are some of the first ones that have launched in the US, and what makes them interesting is they give access to everyone. One of the challenges is that the cost of holding these ETFs is very expensive, because when you're investing into anything via futures, you basically have to roll one future into the next future every month or every quarter, depending on what the roll period is. And that means that you have to basically sell one contract and buy the next contract, and sell one contract and buy the next contract. And that process itself can be very expensive. And particularly in assets that are hard to hold, that roll cost can eat up a lot of your returns. So when some of these futures-driven cryptocurrency ETFs launched, the annual roll cost was in the vicinity of 10 or 12, or I think I saw some had a roll cost of 17% per year, which means just the cost of holding them is already 17%. Then you add the management fees, and that's what you need to earn just to break even every year. So while they're a very convenient way of investing, they can also be a very expensive way if you want to invest for the long run, because of this process of rolling one future into the next. Which brings me to the final group of cryptocurrency ETFs, and these haven't been approved in many markets in the world yet, and I know in Australia and the US they're still waiting to be approved, but these are ETFs that actually own as a sort of physical or cash product the underlying cryptocurrencies. So I would liken them to the gold ETF that we recommend to clients that actually physically owns the gold in a vault in London. These cryptocurrency ETFs will actually own the cryptocurrencies on storage somewhere in the world, and that will be what they're backed by. And it's understandable they've taken a lot of time to be approved, because there are a lot of considerations here. The safety and security of how these assets are going to be held is one, and it's not quite as easy as holding gold in a vault. And so I think a lot of that's getting worked through at the moment. I think once these types of ETFs launch, what you'll need to be very cognizant of is, what is that insurance process? How are they stored, and how comfortable are you with that insurance and the storage process? But assuming people can get comfort with that, I would think that these will be the most attractive products out there, because the cost of owning them on an annual basis will be a lot lower, because they won't have this roll cost. What you'll probably see is the management fees might be a little bit higher, because the cost of storage and insurance eats up some of those returns every year. But I'd say generally these will be the clearest, purest exposures to these cryptocurrencies, and so you won't need to worry so much about the holding cost, but more around the actual security of the assets, which I would assume in most cases the regulators will do a good job ensuring and giving investors confidence around. What I think more broadly though is, once these become easily accessible products in the mass market, you could see a quick period of a lot of people investing into these. But actually cryptocurrencies have already had a brilliant 10 years of performance, and all returned thousands and thousands of percent. So I gut feel is that actually people are going to be a bit late onto this bandwagon, and actually holding out to buy these things for a few years may be a more sensible thing to do once all of these ETFs emerge, because you'll probably see a big flurry of interest. But generally all of the research shows that when new ETFs launch and have a big flurry of interest, they generally don't do well for a few years after that. So in all probability, avoiding the temptation to buy them on day one is going to serve you better in the long run, and then following those rules that I suggested in the last video, which I'll put a link to below. So that is some of my thoughts on some of the new types of cryptocurrency ETFs that are coming out, the risk involved, the benefits. I think it's an exciting development in the industry, and it will only continue. But certainly you need to consider your own personal circumstances when it comes to investing in them, and appreciate that this is an asset class that is in I would describe it as a period of being capitalized. So the market is trying to understand what it's worth, and when assets are going through this process, they see a lot of volatility. So seeing a fall at some point of 70 or 80%, which has happened before, I think should be certainly something you should expect when you invest into these things, and therefore the amount you invest into them needs to reflect that. And that would be my thoughts on cryptocurrency ETFs today.